Hello everyone. In this PPT, I'll explain accounting concepts and accounting conventions. Yeah. Accounting principles are broadly classified into two categories, and the two categories are accounting concepts and accounting conventions. Under accounting concepts, we have 10 different types of concepts, and under accounting conventions, we have 4 different types of conventions. Before going into the concepts in detail, first let us know what is accounting concept. Here, accounting what is meant by accounting here? It is a system which is evolved to achieve a set of objective. And what is concept? Concept means an idea or thought. And here, in order to achieve the goals, here we need to set rules or guidelines. And here, these guidelines are termed as basic accounting concepts. And these basic accounting concepts are the fundamental ideas or basic assumptions. And the concept gives the identification of events and transactions, and these concepts helps in bringing about uniformity in the practice of accounting. Under accounting concepts, the first concept is business entity concept. Yeah, business entity concept means business is treated as separate from the proprietor, and all the transactions are recorded in the books of the business but not in the books of the proprietor. And here, under this concept, proprietor is treated as a creditor for the business because he contributes capital, and here he is treated as a person who has invested his amount in the business, and therefore capital appears in the liabilities side of the balance sheet. And the effects of this business entity concept is, here you can know the financial portion of the business, and then you can derive the earning capacity of the business, or earning capacity of the business can be easily ascertained with the help of the business entity concept. And here, next concept is going concern concept. When you incorporate an organization, you assume that your organization is for long run. Based on these assumptions, you are going to consider all the outstanding and prepaid expenses. Here, miss, under going concept, here final account, you are going to prepare the final accounts, which is made of outstanding and prepaid expenses. And the effects of this concept is working life of the asset is taken into consideration for writing off depreciation only because of this concept. Money measurement concept. Money measurement concept means you are going to consider only the transactions which are measured by means of money. Other than that, you are not going to enter the transaction. That is, which can be expressed in terms of money, those only you're going to consider under the money measurement concept. And next, cost concept. Here, cost concept means an asset is recorded at its cost in the books of the accounts. That is, it record the price at which it is paid at the time of acquiring. And here, in balance sheet, assets will not appear at the cost price every year, but depreciation is deducted. And the effects of this concept is market price is ignored, and balance sheet indicates the financial portion on cost. And here, this concept, it is mainly for the financial accounting. And the next concept is accounting period concept. Accounting period concept, it is usually for 1 year, and our accounting year starts from 1st April and ends on 31st March. And whereas for Marwadis, their accounting year starts on Diwali day. And here, this concept, it gives the financial portion and the earning capacity of 1 year, which is helpful for comparing with another year. And here, this comparison, why this comparison is required? This comparison is required, or it helps the management in planning and also in order to increase the efficiency of the business. And the next concept is dual aspect concept. Dual aspect, the name itself, it is stating that dual aspect, in the sense it has twofold concept. The twofold concept is receiving benefit and giving benefit. Here, for example, when you want to acquire an asset for the organization, so here what you are doing, you are acquiring in the sense you are purchasing. So when you are purchasing, what is coming into the organization? The asset is coming into the organization. And here giving benefit in the sense what it is, what is going out of the organization? Cash is going out of the organization. So when you purchase an asset, asset will come into the organization, cash will go out of the organization. So what is the receiving benefit here? Machinery is the receiving benefit, cash which is going out is the giving benefit. And here we pass two accounts in the books of the accounts, one for the receiving benefit and the other for the giving benefit. And here thus there will be a double entry for every transaction. And the next concept is matching concept. Yeah, matching concept means here the proprietor is interested to maximize the profit and minimizing the cost. And the basic objective of any organization is maximizing the returns, minimizing the risk, maximizing the profit, minimizing the cost. And here under this concept, expenses and revenues are recorded, and these expenses and revenues are recorded which are relevant to the business. Other than that, you are not going to enter those transactions. And the process of relating cost to revenue is called as matching principle. And the effects of matching concept is here he creates the economy, and it is helpful in increasing the efficiency, and it also increases the income. And the realization concept, every business unit like spends money to purchase goods or to manufacture goods for sale. And here profits cannot be made only by the manufacturing. When you are manufacturing it, you cannot make the profit until and unless you send those manufactured goods into the market. Why you are sending? You are sending for the realization, whatever the amount invested on the cost of production, in order to realize that you will sell the product in the market. So here sale of goods either for cash or on credit basis is essential in order to make earnings. And here without realization of the sale proceeds, there can be no profit. So here the effect of this concept is what? Here it is unearned or unrealized revenue should not be taken into the account. And the next concept is accounting equivalence concept or accounting equation concept. Here accounting equivalence or equation concept means assets is always equal to the owner's equity plus liability. Here liability in the sense it means the money borrowed, or you can also give the formula as assets equal to equities. Equities in the sense it is a combination of both liabilities plus capital. And the effect of this concept is the principle of double entry system, that is every debit as a corresponding credit is based on this concept. And the last concept is object evidence concept. Here it relates to the verification of the accounting record with the outside evidence, that is like vouchers, invoices, etc. Means these are the evidences which you need to provide it. And here account remains mentally free due to the existence of these vouchers. And here with this object evidence concept, auditing came into existence. And the next is accounting conventions. Here accounting conventions, under this you have four different conventions. The first one is convention of full disclosure, convention of materiality, convention of consistency, convention of conservation. Here what is meant by convention? Here convention are the common practices which are followed in recording and presenting accounting information of a business. And here according to the convention, accounting convention means a custom or tradition, and here it is used as a guide for the preparation of accounting statement. And the first one is convention of full disclosure. Here According to this principle, all accounting statements should be honestly prepared and all information of the material interest to proprietors, to creditors, to investors, etc. And here it has to be disclosed in the accounting statements. And here every company shall keep proper books of accounts. And then next one is convention of materiality. Here convention of materiality means it deals with the relative importance of accounting information. And here, in order to make financial statements more meaningful and to economize costs, what accountants has to do, accountants should incorporate in the financial statements only those information which is material and which is useful to the users. And here they should ignore the insignificant information or insignificant details. And the next one is convention of consistency. Here convention of consistency, here consistency means here this whatever in the organization, if some principle or some practices or some procedures are following, they need to follow every time the same procedure, the same principle or the same practice which have been followed from year to year. Means convention of consistency, in the sense the convention of consistency, it implies that same accounting procedure should be used for similar items over periods. And the last one is convention of conservation. Here this convention it follows the policy of caution or playing safe. And here it also takes into account all possible losses but not the possible profits or gains. That is, here you should not anticipate, and here you need to provide all the possible losses. Thank you.